Agrawala on the show right now, and along with that, Dipan Mehta is also here with us. A very good morning, gentlemen, and thank you so much for your time. And Dipan, help us understand what are you making of the markets, because it's one day up, one day down, very wild moves coming in on the benchmark indices. But Dipan, the macros are looking strong. The earnings so far, and we are just a couple of days away before we end this earnings season. No major disappointments, rather, is what we have seen. How do you believe that the markets will move from these levels, and what will be the key drivers?
Good morning, and thank you for having me on your show. I just beg to differ slightly over there. I think by and large this earnings season has been a disappointment, and if you aggregate all the numbers, the growth in profits is just 5.4%, the lowest in 8 quarters. So that certainly is a cause of discomfort, and the expected improvement in earnings has not taken place. I think the markets are in a very tight range because liquidity will not allow them to go down, and fundamentals are not justifying a rally in stock prices considering the valuations, especially keeping in light that a lot of large companies and large parts of mid-cap companies also are seeing secular slowdown in growth of earnings. So keeping these two in mind, I think we may have a more sideways movement for many more months. And more importantly, I think the market will get extremely selective within sectors and even stocks within the sectors. And some of the investment themes also, you will find the players in those investment themes, only few of them are kind of doing well. So I expect the next few weeks or months to be selective and range bound.
Sure, okay. So that's the take coming in on where we're headed, given that we've just wrapped up the earnings season in terms of all the Nifty 50 companies, and we've seen good show coming in from Apollo, decent coming in from ONGC as well, and we'll talk about that in some time. But Dipan, 2 earnings we saw yesterday, Honasa Consumer and Nykaa, both on that BPC consumption discretionary spending side. I don't know if you've had a chance to go through the numbers, but both of them look rather decent. Honasa, in fact, a beat versus estimates, and Nykaa looking in line. What are you making of this trend that we're seeing in the market right now? Because it's continuous good quarters coming in for both of these companies.
I would call both these companies as new FMCG companies, because end of the day, if you look at the other old FMCG companies, the growth has completely disappeared over there. The likes of HUL and ITC and Nestle and some of the other companies, they are operating in mature categories. So investors who still want to look at investing in FMCG companies, I think beauty and personal products, the BPC segment, is really where the growth is, as is demonstrated in the earnings of especially Nykaa. Honasa, okay, I mean, they gave numbers which were better than street expectations, but look at the year-on-year comparison. So I wouldn't look at that company in more positive light. But Nykaa, definitely, I think, very impressive set of numbers. And if they can get the apparel business right, the fashion business right, and reduce the losses over there, then I think eventually investors will reward the company, and we may see stock prices rallying from these levels as well. Very positive on what Nykaa has executed, because it's a very difficult business, and what they've executed and their positioning despite emerging competition is very impressive. And if they go on this path, I think it will again resume its wealth creation journey.
All right, that's about the select earnings candidates. But along with that, we also had the numbers coming in from Apollo Hospitals, a very strong show this time around. And like we have been flagging off, the trend this time is definitely highlighting that the hospitals are doing very well, and not just that, the commentary is also very good in terms of the growth prospects. And see the case for Apollo Hospitals as well. It has not just been a double-digit growth and a surprise on all the parameters, but the segmental performance, be it from hospitals, the healthcare division, 24/7, they all have done very well versus what the street was penciling in. And add to that, the company has also maintained its double-digit growth guidance for FY26, and of course we will be speaking with the management itself at 9:40 a.m. But Aditya, help us with your analysis on Apollo Hospitals, because we were just trying to draw the parallels between what happened to Fortis post the earnings, and can similar be the case for Apollo Hospitals. But yes, Apollo is definitely a bigger player. But what's your sense on the charts? But first of all, good morning.
Morning, Srishti. Thanks for having the show. Absolutely, there's no doubt about the fact that it's been a very strong show for Apollo Hospitals. If you take a look at the chart setup over a longer period time frame as well, constantly making higher highs, higher lows. So this shows that the stock has been outperforming, and the outperformance is likely to continue in the coming quarters as well, Srishti. So definitely, there's no doubt in my mind that the stock is headed higher. From current levels. On the upside, immediate hurdle though comes somewhere around 7,600, which happens to be its previous peak, and stock has made multiple attempts to cross this hurdle of 7,600. Unfortunately, it has failed to do so. Let's see if after these good numbers, if the stock actually finally manages to cross these levels of 7,600. Then the targets come somewhere around 8,200 to about 8,400 on Apollo Hospitals. But as of now, I would play with the target of 7,600 initially, and if that is taken out decisively, I'll play for a target of 8,400 on the upside. Whether one should buy after this gap up open, if they're going to witness one, definitely with a stop loss somewhere around 7,100. My sense is one should look at accumulating this stock and adding in your portfolio.
That's a take on Apollo Hospitals. Chandan, we were just talking about Paytm on the fundamentals now that they have received the RBI nod for the online payments aggregator license that has come in for them. But give us a chart check on what Paytm has done, because we've seen some solid growth for the stock recently. So where do you think the stock is headed? Because fundamentally, this news flow is very positive for the stock.
Yeah, so stock has been making higher tops, higher bottom on the monthly chart, or in fact, 2 days back, the stock gave a major breakout in the momentum by rallying towards 1135 levels. Technically, it completed a pole and flag pattern, which is bullish implication. In fact, the rising trading and the delivery volume also indicate the bullish resistance in the counter. So I believe with support of 1100, Paytm has potential to rally towards 1180 to 1200 kind of levels.
All right, so that's about Paytm. Definitely holds that potential to move higher even from these levels. But along with that, we also have the numbers coming in from HAL as well. Seems like a good set, because most of the brokerages have actually gone ahead and reached the target price on this particular counter, when specifically Nuvama is highlighting that it's indeed a positive start with strong pipeline for growth as well. But Dipan, the other talking point remains to be the valuation. What's your take on that?
Well, that's the issue, that, wherever there is growth, it's being valued at extremely rich earnings multiple. And that clearly is a challenge because, with such high P multiples, even if the company does deliver on its profit and growth projections, what happens into the future is that the earnings, the P multiple keeps getting compressed. So really, it's a challenge to find good quality stocks even after such a mild correction. And we remain on the hunt over there. I think, evaluating many stories, but don't have any specific ideas on hand. But broadly, after looking at the earnings season, wherever I find that there is 15-17% type of growth rate, which is consistent, which is secular, where it can sustain for 3 to 5 years, where there's longevity, those stocks are trading anywhere from 50 to 70, maybe 100 times their price to earnings multiple. And that is unsustainable if you want to get good returns over a long period of time. So that clearly is the challenge. And clearly, I think there are two sets of companies, those which are able to grow above the nominal GDP growth rates, and those that are not able to grow above the nominal GDP growth rate. And the number of companies which are not able to grow beyond the nominal GDP growth rate is steadily increasing, and that really is a cause for concern.
Okay, so that's the take on HAL, and that stock will also be in focus on the back of its earnings and some brokerage target price hikes like Shrishti was mentioning a while ago. But we also have my colleague Ashesha who's joining us to understand some other stocks that could be in focus in today's trade. Ashesha.
Well, yes, first up, let's talk about Karnataka Bank. It has reported weaker than expected set of numbers, and the company, remember, is also undergoing management transition, so that continues to weigh heavy. But net interest income has seen a downtick of nearly 16% on a year-on-year basis. PAT saw a fall of about 27% YOI, and asset quality has also deteriorated. So GNPA stood at about 3.46% versus 3.08% that the company had reported in the previous quarter. So weak set of numbers coming in from Karnataka Bank. Meanwhile, a whole host of mining counters will be in focus, the likes of MOIL, GMDC and NMDC. And this is because the Lok Sabha has now passed the bill to amend Mines and Minerals Act. So any kind of fresh developments that comes in from this amendment will be crucial for the entire mining sector. Shifting focus to Interglobe Aviation then, negative news flow coming in for this airline, where DGCA has now issued show cause notice to Indigo for simulator training lapses related to 1,700 pilots. And lastly, let's also talk about Nazara Technology. One, it has reported its numbers largely in line with what the street was working with, but there's a positive. It has announced bonus issue in the ratio of 1:1, and this could perhaps be the reason the stock will be in focus today.
Dipan, what's been your read-through when it comes to the entire banking pack? Because the MFI segment pressure pretty much seems to be the case across the board. Of course, larger in quantum for a particular companies wherein a large chunk of their book has MFI exposure. But how should you treat banks right now? Do you think it becomes a bottom-up play? Do you buy the dips which are coming in after the earnings? What do you do? Or stick with the leaders?
Yeah, Aisha, I think one of the biggest disappointments of the earnings season has been the banking sector. And we thought that the net interest income and the pre-provisioning profits would show improvement, but that has not come through for various reasons, despite interest rate cut and despite improved liquidity conditions. We also thought that the provisioning for NPAs would kind of, move in line or slightly higher than the growth in pre-provisioning profits, but that also has not happened. And that's really a cause for concern. I think if you strip out the kind of earnings growth which has come from some of the PSU banks, by and large, a whole host of NBFCs and especially private sector banks have clearly disappointed. And my understanding is that now this industry is a red ocean, and it's very difficult for banks to sustain the kind of growth rates that we were used to earlier in, say, about 4 or 5 years ago or so. So although it is a very high weightage in the sensex and nifty, and that's one of the reasons why the sensex and nifty are not moving up, because the banks per se, I think the earnings growth is not that impressive. So as I said, although they're a large part of the weightage, I think that we feel that going forward, we'll have to look beyond this sector to get outperformance versus the broader market indices. Of course, there could be a cyclical improvement because of lower interest rates, good festive season, but it's not that this industry is, the way it was, where we were assured of the large cap players, we were assured of 15-20% type of growth rate. I think that's certainly not going to happen.
And that is the problem, right? Dipan, like you rightly highlighted, the massive chunky weightage that banks have in the indexes and various other, parameters as well. Where do you think the next leadership would actually come in from? Not weightage wise, but, purely at least forming a large chunk of the weightage, if not matching up to banks, at least close by.
That's the tough one because we have banks which are, not that impressive. And then we have the entire software sector, which really disappointed, and they are in a secular stagnant situation, with very low single-digit growth rates. And then we have the pharma, which is also a large weightage. That has done well, no doubt. A lot of pharma companies have given good returns, good performance, but there's this sword of tariffs hanging on them, and how that will play out. Given that situation, you cannot really give a higher valuation multiple to that segment. So what perhaps you're left with is capital goods. And there is a certain degree of earnings volatility. But by and large, you look at companies like L&T, KEC International, Kalpataru Power, ITD Cementation, and a whole host of companies engaged, Afcons also you could add to the list, whole host of companies engaged in building infrastructure, in building the capacities within the industry. They are broadly doing well. So I think that remains the engine of growth as far as we are concerned. And that should be one sector where investors can be overweight in. There's also the entire power equipment and the solar and the wind power, that entire clutch of companies also which have reported good earnings and are doing well. So that I think in a way it is the leadership sector, or could be the leadership sector, but their weightage is still within the Sensex Nifty is pretty small. And there is perhaps a ray of hope when it comes to the two-wheeler companies because of better monsoon and revival of demand one could see over there. But as I said, it's a challenge. One cannot really put your finger down that these industries are doing really well. Of course, cement also did pretty well last season, but we all know it's a cyclical industry. And although profits were higher, I thought by and large the volumes disappointed, although it's not a great season from volumes perspective.
All right, so time to be very, very selective, and cap goods and two-wheelers are some pockets that you can look at this point in time. But with this, let me also welcome on board Rajesh Palve on the show. Hi Rajesh, morning. And one of the stocks that I wanted to chat about was actually Bharat Dynamics. One of the other defense